Asian shares tracked Wall Street lower as sticky U.S. inflation forced markets to slash bets on how much the Federal Reserve might ease in 2024. European shares started on a tepid note as caution dominated the mood ahead of the monetary policy decision by the European Central Bank. Locally, electronics company Ellies, which was a South African household name for decades, will be liquidated. Ellies went into business rescue, voluntary business rescue at the end of January. The liquidation announcement was released on the JSE 45 minutes before the market closed yesterday. However, the group's shares still plunged 50%. The plunge saw the share price just close at around 1 cent a piece. To give us more perspective on the markets, we are joined by Ricardo Smith. He is from Absa Investments. Ricardo, thank you so much for your time. I suppose what began as a snoozy start to the week all changed yesterday at 2:30 South African time when we saw that US CPI report. What did you make of the market reaction to that figure, as well as, I suppose, call it market sentiment now that we've looked at the figures?
Yeah, it is, certainly a negative response to those numbers. It was quite disappointing. Seeing some of the cyclical effects like energy ticking up slightly, coming in higher than expected, both headline and core. And so this does imply that we may see rates, being a bit stickier, which is not particularly, good for markets. Markets were hoping for a cut in Q2, but I think it plays into our narrative of a potential cut in Q3 instead.
Okay, so let's take in this US CPI figure that we've received alongside all the other data points we've gotten over the past few weeks. I mean, what kind of picture does it give you about the US economy? And also, I suppose the second part of that, does the Fed need to cut then if the US economy is so strong?
Yeah, that is a difficult one, and I think one, thing that they haven't been able to answer is what is their natural, rate of interest that they should be targeting. And at the moment, they don't seem to have, pinned that down. So they don't know how expansionary or contractionary they are, at a point in time. And certainly, indication is that inflation going forward is likely to be higher, and rates are likely to be expected to be higher over the next 10 than the last 10 years. And in particular, when you look at it, some of the sticky elements like services, so it is second round effects, it is, pass through, that is a lot stickier than some of the supply side shocks that initially shot that inflation print up to 8-9%. So there's still quite a bit of work on the Fed's hands on understanding the new inflationary regime, what their ultimate target of interest rates need to be, but they do still seem, quite adamant, to cut, but it may not be as aggressive as what market participants were hoping for.
All right, let's bring things locally. We had WeBuyCars list this morning. The IPO price was 18.75. They opened at 20 Rand. Is there value in the share or even in transaction capital post the unbundling?
Yeah, I think, the value in the share will have to track it quite closely over time. It is a bit expensive if you look at their core earnings over the last 12 months. The market cap of about 8 odd billion, implying, price to earnings multiple close to 30, compared to some of the competitors in the space. That is quite, expensive. But of course, WeBuyCars does come with prospects of growth relative to those competitors, and it has been growing in double digits. To what extent it's able to sustain that going forward, will be seen. And so, that's part of the tricky bits of new listings. Getting to a true fundamental price on transaction capital. I think it really depends on how well they are able to contain, some of the issues around debt of their remaining businesses. And, that's largely where we'll see if they still value there.
What are your thoughts?
They do get a huge cash injection, though, from the sale.
Sorry to interrupt you. What are your thoughts on buying new listings? Do you go in on the first day, or do you wait a while to see how the company performs as the months unfold?
Now, I think, from our perspective, managing large share portfolios, we do find it tricky to enter on the first day. Issues of valuation, of volatility, but quite importantly, we also find that liquidity can be, a bit, tough, especially, on a market cap of 8 billion. It's not the biggest company on the JSE, and so trading volumes are likely to be thin, and interested parties are likely to bid prices, up a bit further. It does help that there's an initial capital raise of 1 billion that is automatically injected into the market, but we do struggle with liquidity and finding a stable price.
As we wrap up, tomorrow we kick off earnings season with the US banks. And I'm sure there's a lot of themes we can unpack for this particular quarter, but the one theme that you're going to be paying attention to?
I think the biggest will be how resilient the economy remains, and that will be seen by consumer spending propensities and whether we're still seeing revenue growth, in the services sector, and the impact of interest rates on balance sheets, and whether there's elevated refinancing risk, and that's starting to creep in to earnings net of interest, will remain fundamentally important, to judge where, the markets are seeing the economy.
All right, Ricardo, thank you so much for your time. That is Ricardo Smith, who's the Chief Investment Officer at Absa Investments. As he mentioned, we are kicking off US earnings season tomorrow, and we're going to be paying attention to a number of themes, namely whether we're going to still be seeing that concentrated growth in the second quarter. What do margins look like? What are expectations, especially for earnings going forward? So all of that will unpack as the days unfold. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.